Hello, everybody. I'm your host, Eric Bird, here at StopStrugglingNow.com. And today, we're going to talk about how the Federal Reserve is wiping out the middle class, how the Federal Reserve is hurting you financially by bailing out banks, by the FDIC taking over banks, and we're going to talk about how you are affected. I'm actually going to show you how you're affected. What are we going to do about it? Because we have to have solutions, ladies and gentlemen, and you know what that means. Get your assets that pay you. But let's get into what the problem is, and then we'll have solutions. And welcome. Stop struggling now, gear. Check. And please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, welcome back, ladies and gentlemen. And I want to thank you so much for being here. And please share the videos because you never know who you're going to be able to help. Is that not right? Somebody's actually looking for help as we speak. Are you going to facilitate that for them? And also, make sure you pay attention because there's lots of information that may slide by a lot of people. So let's go over to the Stop Struggling Now YouTube channel, podcast page as well. And please notice, we have a join button over here on the right-hand side. Now it's switched to the far right-hand side. If you'd like to become a member of the channel, as you can see a few here, you receive special messages under this community tab. You receive 1 or 2 messages or videos per month specifically for you. You also can join me on any live stream, live on screen, and discuss any subject matter that you want to talk about. And also, you have special emojis. And also, there's special deals when it comes to Stop Struggling Now gear. Now, let's get into the situation at hand. Today, after the Federal Reserve did a 0.25 interest rate increase, this is what happened with the stock market. A slight increase after stocks were going up, stocks were going down. We ended a little bit level, let's just call it. Nothing really extravagant has happened. And then notice the top 10% that owns 89% of the stock market. Notice the stock market keeps going as expected. Now, we're going to get into something else, though. That Federal Reserve rate hike, 0.25, keep this in mind. When they are bailing out any company, or when, for instance, First Republic Bank is getting $5 billion from JP Morgan, Citibank, Bank of America, and Wells Fargo, that's $25 million from them. Then there's other smaller banks that are giving like $1 billion each, like the Mellon Bank of New York. It equals $30 billion. When you start adding up all of this debt, just think about $30 billion for them. Think about what's happening at SVB Bank. Think about other bailouts and other loans that the Federal Reserve gives to people. 0.25, just start thinking 0.25% owed on $1 trillion. It's not chump change. 0.25 may sound like just a little bit, but if somebody's already paying 4% and then now they have to pay 4.25% and you owe billions of dollars, that little 0.25 is worth millions of dollars on top of what you're already paying. So now who's going to bear the burden for that if you already do not make any money? This works the same way in business and for individuals. So indicates increases are near. Excuse me. When they said increases, indicates increases are near an end, this is a signal to let people know that even though we're at 4.75 to 5%, that they're telling people we're going to 5%. So there's going to be another 0.25. Another 0.5, unlikely. Another 0.75, unlikely. A 1%, totally out of the question. Our economy is fed on lies and quantitative easing. $8 trillion over the last year and a half, the Federal Reserve has pumped back into the economy, into the United States money supply, so to speak. That means everything is going to cost more. They've devalued the currency. So for them to come out here and talk about increase is near, guess what? Inflation is going to continue. They have printed more money out of thin air. All right? So you have to understand that. And by them doing that, now we're going to come in here and talk about what the federal funds rate has been doing. You can see a chart here. Look at this. This is nonsense. Here's their target rate. All right? That's fair enough. But look at here. In 2020, they were trying to get damn near down to zero. They were. And look, from 2009 until 2015, 16, look at this. Look at the federal funds rate. Is this ridiculous? And now you wonder why 6, 7, 8, 9, 10 years, even up to 2% is still ridiculously low. Now you can understand for 10 years why there would be a bull run in the stock market. For 10 years, you can understand why there would be housing price increase. And for 10 years, you can understand why billionaires and billionaire companies can turn around and borrow money at 1% and not have to pay interest only for 10, 12, 15 years. And no wonder they're out here buying up properties, multifamily units, while they're buying up anything and everything, other businesses, because they can borrow billions of dollars and pay back less than 1% in interest only. You would be buying up billions of dollars worth of companies as well, especially since those companies are real. They're not fake. They're real. They have real profits. They have real revenue in the millions, or some cases billions. So we're building up our own portfolio based on the back of, guess whose money? Taxpayers' money, because they're giving them loans. All right. So look at the federal fund rate after, this is right here, February 2022. This starts creeping up to just 1%. It's July 2022. This is only 2023. They're making it seem like they were doing this for the last 3 years or 2 years. They have not. 1% federal funds rate, really? Come on, ladies and gentlemen, that's a travesty. They didn't even get up here to 1.63% until July 22nd. Look at this. October 7th, they're at 3%. Is that anything? This is ridiculous. Now we're up to 5% federal funds rate. And it's not even been a year. Who cares about 0.38%? Who cares about this? This is 2022. This isn't even a year has gone by. So this is what I'm saying. If you're really trying to fight inflation, then they would have actually went up to, this would be 7 or 8% right now. But the reason why they can't do that is because people are holding loans. You start adding another 2, 3, 4% onto trillions of dollars of debt. Now you understand why they have to signal we can't go any further. Because if they're really trying to break something, they would go over the 5.5 to 6% range. They would actually really be trying to reduce inflation. Inflation will not stop, ladies and gentlemen. I just want you to understand that. That's how crazy this is. All right? Now, I left something out here that I wanted to get into, and it looks like I'm going to have to go find it, unfortunately. And I was actually going to come into the decision that they made affects you, and this increases. It looks like I'm back to the beginning of what we're talking about, but I'm going to have to do this in real time as we're doing it. I'm not even going to how the Fed rate affects you. I'm going to do it this way. And I'm looking for the CNBC because I want you to, here it is right here. This is what I wanted to get over with today. I'm going to make this a little short. We're about 8 or 9 minutes as it is already. But there's going to be a link down below for this. Exactly. All right. Notice this. Here's what the Federal Reserve 25 basis point interest rate hike means for your money. So everybody on podcast, you guys can hear this right now. This is exactly what the real deal is right here. The Fed is blowing up our financial system, says Strike founder and CEO Jack Mallers. Or Mahlers. I don't know how to pronounce his name. I'm not familiar with him. He's exactly right. He is exactly right. Now, look at this. You're holding credit cards, that 0.25, means more than 0.25 to you because they're going to raise the interest rate on you. All right? Think about that. And here's what the balances are. Trillion dollars, ladies and gentlemen. 943.5 billion, January 2023. Imagine $1 trillion, like I keep saying, goes up another 1%. That's millions of dollars, ladies and gentlemen. Millions. All right? That's what's happening. Look here, home loans. 15 and 30-year mortgage rates are fixed, tied to the treasury yields and the economy. Again, we start talking about 6.6. Then you start talking about 7%. Then you start talking about 7.5. Then you talk about 7.77. Then you talk about 8%. All of this comes into play. So again, the markets aren't slowing down because they signaled that we're going to be okay. Now, look at this. HELOCs are pegged to the prime rate. Most ARMs adjust once a year after an initial fixed rate period, but a HELOC adjusts right away. Already the average rate for a HELOC is up to 7.76 when it was 3.96 just a year ago. Now you understand what I was talking about. Just a year ago, everything's like normal while they're blowing up the economy and creating inflation. Now people have to deal with this. Auto loans, again, you're going to have to pay more. Just call it what it is. Again, it's very, very simple. The average interest rate of a 5-year new car loan is now 6.48, up from 1 year ago, which was 4%. You guys start doing your mathematicals, which is major. Start putting in a $50,000 vehicle at 4% versus paying for a $50,000 vehicle at 6.48%, and then do what most people are doing past 5 years, and you start doing 6 or 7 year notes, and all of a sudden you're like, wait a minute, I'm paying all this extra in interest? That's right. So student loans, once again, remember, it's going up as well, because most borrowers won't be immediately affected by a rate hike. If you are about to borrow money for college, the interest rate on a federal student loans taken out for 2022, 2023 rose to 4.99. It's 5%, up from 3.73% last year. That's significant, that 1.2%. When you start talking about $50,000, $20,000, $50,000, $100,000, 1% is another $1,000, $2,000 per year if it goes 1.75%. This is significant as well. All right, I'm just saying, savings accounts and CDs, okay. All of a sudden, 5%, much higher than last year at 0.75. By the way, Wealthfront down below, 4.3% for a savings account in case you don't have a savings account higher than that. But there's something even better. If you put in any money with Wealthfront, they manage your money for zero cost. Anywhere from $500 to $4,999 is managed for free. Once it goes over that $5,000 number, then you pay their Wealthfront management fees. But again, 70% of the population doesn't even have $1,000 in their bank account. 60% of the population does not have $500 in their bank account. So just keep that in mind. So whenever you can get an additional savings and some money in your pocket, this is what you have to do. Speaking of that, now we have to start talking about one thing and one thing only. Since we're sitting here at CNBC, let's just get things simple. This will be easy for you. Dividend investing is easy for you. There's something called PSEC. It's over 10% now. Prospect Capital. P is in Paul, S is in Sam, E is in Eric, C is in Charles. All right. Now go with something simple. JEPI, JEPI. That's J is in Jordan, E is in Eric, P is in Paul, I is in India. JEPI, JP Morgan, 12%, 11.8% dividends is what they're returning. I will go with JP Morgan every day. They're a Fed bank. And if they're giving me 12%, that's where you should think about putting your money. If you haven't downloaded your brokerage account and don't have one yet, please use the links down below with Robinhood and Webull. That can help you out. Now, you get free shares of stock if you download those apps. You don't even have to upload money. They'll give you a free share of stock, all right? So once you upload money with Webull, you might get additional stocks to boot. Wow, let's get back into this as well. We mentioned JEPI. We're going to go with IEP as well. If you're missing live streams, you would have already had these, but I'm letting them go right now. I is in India, E is in Eric, P is in Paul. That's IEP. All right. So there should be a good start for you. Then you can go with some REITs, because if they're going to stop doing any interest rates increases, this is great for REITs. This is great for rental properties. So now you should be getting in now while their share prices are lower than ever, and they're giving you these double-digit rate of returns for their dividend. So you can go with AGNC. That's A as in Apple, G as in George, N as in Nancy, C as in Charles. All right. So some of you may be thinking, oh yeah, okay, he's reading on something. No, I'm not. Okay, ORC, Orchard Capital, O is in Oscar, R is in Robert, C is in Charles. All right. There's another one. And then this one you need to really check out. All of these, do your due diligence. M is in Mary, V is in Victor, O is in Oscar. All right. There's another one for you. You want something else? How about N is in Nancy, L is in Larry, Y is in you. Yours, Y, NLY. You want another one? And this will be the last one. A is in Apple, B is in boy, R is in Robert. Okay, there's more, but I'm just going to leave you with those right now. Otherwise, join us on live streams and you guys would Monday, Wednesday, and Friday, and you would know more about these. So with all that said, ladies and gentlemen, there are some solutions here. That's the easiest one of all. All right. And then remember, everything you put your money into is a risk. Even if you drop your money at the bank, most people don't even know the fine print says that is now their money. It's no longer your money. So once you understand what's going on, then you can make decisions a little differently. And with all that said, thank you for watching. Thank you for listening. And please like, subscribe, and click the bell below so you get the latest updates. And I know it's hard out here. And that's why the Federal Reserve is not your friend. They're not sitting around here going, hey, we're worrying about the little guy. We don't care if we bury him, is what they're saying. They're not thinking of you. They're thinking of all these corporations, these billionaire, millionaire class that's sitting there that has corporations who's getting loans we're giving money to. They're worried about them because that's where their main concern would be. Just like if somebody comes to you and you loan somebody $1 million. And then somebody comes to you and says, hey, you know what? You should be worried about the neighbor across the street. You're going to be like, no, man, this dude defaulted on me for $1 million. I need to worry about if I'm going to get that money back. I don't really care if this guy over here needs a loan. I don't really care if I'm going to destroy the economy because I actually got to give this guy more money so he doesn't default. And I don't care if that guy across the street is going to be paying for it. He's not giving me $1 million. That little piddly stuff this guy's worrying about. We're worrying about million, trillions, billions. So whatever the fallout is, we don't really care about that. These guys control 90% of the economy, so we're going to worry about them. That's pretty much how this goes, ladies and gentlemen. You have to understand what you're working with here. So get your assets that pay you now, because this next bull run, it's coming starting in the next 5 months. So if you don't get a hold of some asset and control some asset, put it under contract, get something like dividends where you can get 15, 16, 18, 20% return, because that's going to stay there as long as that company's profitable. Your return, if they keep their dividend rate the same, or dividend amount that they're giving you, then that means your return on investment stays the same and gets better because you're going to reinvest it. So I flip back and forth, but hopefully you understand. If you have any questions, you can always make comments down below. I'll respond, and there's other people too that's more adept than me, and they'll respond and help you out as well. So with all that said, keep your head up, keep moving, and I'm out.